All right, let's get some more analysis now on how U.S. interest rates impact China. For that, we're joined live from California by Dan McClory, President and Head of China at Boustead Company. Good to have you back on.
Thanks, Rachelle. Good to be here.
Now, as we heard there does seem to be some debate as to whether the People's Bank of China could or should raise rates in the next year or so. What are your thoughts on that?
Well, I don't think they should. It's pretty obvious that the recovery in China, if we want to call it that, and the maintenance of the 6 to 6.5% growth target will have a somewhat direct relationship on that decision. So I don't believe they're going to be raising rates anytime soon.
Now, we did see that China experienced a rise in capital outflows after the last Fed rate hike. So how concerned should China be about that in the wake of this latest rate hike and more potential tightening?
There should very well be concern. This is a trend that has heightened, as we've heard from our correspondents around the globe. These net outflows are getting to a serious level, perhaps somewhere around 120 billion in November after about 40 or 42 billion in October. That's a 3x increase, and the total for the year is somewhere around $500 billion. So these are serious numbers, Rachelle, and I think it's something that really has to be looked at, and it has to be addressed.
And obviously more ahead, the U.S. Central Bank signaled more rate hikes ahead for 2017. What impact do you think that could have on corporate debt and perhaps even overseas expansion for Chinese businesses?
Well, as we know, there's a fair amount of dollar-denominated debt that Chinese companies have used, not just to expand internationally, but also in China. The Chinese have been very good and very prolific about scouring the globe for the best rates of capital. So any increases like that is going to have an extra effect on the cost of funds to those Chinese companies, and it may well, in fact, get in the way of expansion plans. And, you know, the irony of this, Rachelle, when we stop and look at it, is when you consider some of the rhetoric coming out of Washington and some of the political overtones about China's handling of the currency, it's the exact opposite of what the quote-unquote conventional wisdom is. And that is, you know, China is working in the hardest way to support the currency as opposed to artificially bring it down so that they have some trade advantage.
So if you're one of these multinational firms and you're hearing all this rhetoric, what should you be doing then in terms of adjusting your strategies?
Well, clearly for a multinational firm, you know, coming into China, you know, what you're going to want to do is to be sourcing those components. If in fact they are less expensive, you're going to want to source components from China. You're going to want to maybe even sell components. But I think it has to do with components that are throughout the value chain. So not just finished products, but a lot of components, as we know, come out of China and find their ways into many of the other industrialized economies of the West and are part of that value chain. So I think some of the multinationals may be perceiving that this is a good buying opportunity for those components to come out of China, go into value-added products elsewhere, which of course would continue to drive the Chinese economy, and it wouldn't result in a total standstill on foreign investment in China.
Now, Dan, another key issue, people are looking at Beijing's strategy for the RMB's depreciation. How should they go about stemming the Chinese currency's fall against the dollar without choking off growth?
It's a great question, Rachelle. And you've got pundits on all sides of that argument. Some say that there should be a one-off, large devaluation that would send a signal to everyone, the small savers and investors in China, the large multinationals, that we're not going to continue to see these adjustments and that there's not going to be continued strain on the money supply in China because, remember, China's selling dollars to buy RMB to help the currency stabilize. So one school of thought says that devaluation should take place, get it done, get it off the table. Now, that would potentially have a very detrimental effect on many of China's trading partners throughout Southeast Asia who are yuan denominated and are doing a lot of trading with China. It would overnight make their cost of capital, in some cases, almost prohibitively expensive. So that's probably not the best way to go.
Right.
And I think this gradual attempt at maintenance is probably for the time being the best way for the government to address it.
All right. Well, thank you so much for your insights. We'll have to leave it there. Dan McClory, President and Head of China at Boustead Company.